Welcome everyone to the 2021 MySuper Annual Members Meeting. My name is Shauna Black and I will be your host this evening. I'm a Trustee Director of MySuper and the Chair of its Investment Committee. I'd like to begin by acknowledging that I am hosting this meeting from the lands of the Wurundjeri and Wurundjeri people. I also acknowledge the traditional custodians of the various lands on which you all gather today, and the Aboriginal and Torres Strait Islander people participating in this meeting. I pay my respects to elders past, present and emerging, and celebrate the diversity of Aboriginal peoples and their ongoing cultures and connections to the lands and waters of Australia. We have with us this evening a quorum of directors, that is 8. I'd like to acknowledge the other directors of MySuper who are on this webinar and whose photos are on screen now. We have apologies from Dale Bridle. Also present are all senior executives and the external auditor, Dave Salmon from Deloitte. I should also add that we have an apology from Katrina Ford and also Gary Campbell. Welcome everyone joining us from across Australia and the world to our live webinar, once again run exclusively online this year. Tonight's meeting will be recorded. A reminder that any information presented tonight is of a general nature only and does not take into account your personal objectives, situations or needs. Find out more information by reading our product disclosure statement available at mysuper.com.au/PDS. With regard to investment returns, they are not guaranteed, and past performance gives no indication of future returns. Also, a reminder that tonight is a members meeting and is not a public meeting. It is not appropriate to make media reports about this meeting. And so to the agenda. Tonight you'll hear from MySuper's Chair, Susan Heaney. Then our CEO, Tony Griffin, will give a fund review. Finally, our Chief Investment Officer, Michael McQueen, will detail how MySuper has travelled in the financial year to 30th of June 2021. At the conclusion of Michael's presentation, we will move into the question and answer section of the event. And now for some housekeeping. While I'm sure by now many of you have been exposed to Zoom or something similar, I will quickly point out some of the options available to you today as you participate in this live meeting. If you'd like to ask a question about MySuper, of the board or the executive, you can do so at any time using the Q&A button on your screen. It is in the middle of the bottom of your viewer if you're on a desktop or laptop. While we certainly encourage you to ask questions throughout the presentations, we will only be responding to your questions after the prepared speeches have concluded. Any questions that relate to your account or specifically to your circumstance cannot be answered in this format. We have left time for questions at the end. However, should we run out of time tonight or it's not reasonably practical to answer your question, we will have a response to your questions available on the website in the next few weeks. A reminder that we cannot answer any personal or account-sensitive questions within this forum, although a member of our team can be in touch to assist you following tonight's meeting. Also, in the next few weeks, you will find a recording and minutes of tonight's events on our website. Let's begin tonight's meeting by hearing from the Chair of MySuper, Susan Heaney.
Thank you, Shauna, for your kind introduction and also for giving your valuable time this evening to facilitate our event. In fact, Shauna personifies so much of the great resilience, expertise and agility that are the hallmarks of MySuper's hardworking membership. Not only is she an experienced and respected newspaper journalist and editor of many years standing, but Shauna is also a director on the Australian Council of Super Investors. She has been a trustee of MySuper since July 2018. And in addition to that, she also chairs our investment committee. If that wasn't enough, Shauna also finds time to work in her own small business, Black Stump Media. Like Shauna, I'm also a business owner, and I know all too well the struggles and uncertainty employers and employees alike have been experiencing against the backdrop that has been the ongoing COVID-19 pandemic. This was my first year as chair of MySuper, and to say it's been a significant 12 months is perhaps a bit of an understatement. I spoke with you all last year at our annual members meeting, and I used the phrase then, unscheduled bumps in the road, when I was referring to COVID. Unfortunately, as you all know far too well, those bumps have continued, and in fact, they've become even more regular as each day passes. We can, however, do our best to cushion ourselves from the impact of these bumps by having long-term, sound strategy in place that is monitored with good governance and risk management processes. And I'm pleased to report that it was these processes at MySuper that resulted in our highest annual returns for members in more than 20 years. These results are also the testament to the values and tenacity shared across the MySuper executive and board alike, who've all dedicated themselves to providing solutions that offer continued improvement, longevity, and successful outcomes to our members. Nonetheless, the year we're reflecting on this evening has unavoidably been a very difficult one. COVID's impacts to our core print, media, entertainment, and arts industries are ongoing as we continue to feel the financial fallout and even the social fallout from this pandemic. It's been especially difficult to see so many of our members going through tough times, especially those in the live performance sector, which was just starting to get back on its feet before Delta, and then Omicron, and then it was either shut down or further delayed again and again. At MySuper, we remain passionately committed to supporting our core industries and hope that Australia's roadmap out of COVID-19 will afford our industries a more stable recovery in the year ahead. Now, you may be surprised to know that COVID wasn't the only story of the year, even if it sometimes felt that way. The final month of the last financial year saw the federal government pass new superannuation legislation in Parliament called Your Future, Your Super. And our CEO, Tony Griffin, will discuss that in more detail during his presentation. The government says that these reforms are to remove unnecessary waste and to increase accountability and transparency and to provide more flexibility for families and individuals. Whilst at MySuper, we are broadly supportive of this approach, only time and implementation will tell just how successful these measures will be. We hope that whatever additional changes may be introduced in the future will be based on what is best for all working Australians in helping them achieve a comfortable retirement, and not just on ideology or point scoring. It's an environment at present where complexities of regulatory change, investment opportunities, and member demand for digital and advisory services continue to grow. And to us, this means it's become increasingly difficult for smaller members like us and others to remain cost effective and provide members with more choice and opportunity to grow their superannuation retirement savings. As you would all know, for some time, MySuper has been considering teaming up with a larger industry superannuation fund to see whether we can gain benefits of size while keeping our unique character. And with this in mind, I'm proud to confirm that in July 2021, we celebrated a milestone in this journey with our proposed merger with the super fund for the building and construction industries, Cbus Super, with the two funds signing a successor fund transfer deed, or as you'll hear a little bit tonight, an SFT for short. While there are still many approval processes that need to happen, both funds are working towards completing the merger process before the second quarter of 2022. By belonging to a much larger fund, MySuper members will gain opportunities for investments at a competitive cost and also for benefits to their portfolio of products and services that will help will help them improve their retirement outcomes. Media Super members have much in common with CBUS members in terms of the nature of their work. Many are self-employed, while others work on fixed time, term, or casual employment contracts. Like the construction sector, their workplaces are also often disrupted. Furthermore, Media Super and CBUS share the same profit for member status, which includes equal representation, comprising directors from representing both employers and employees, as well as having a component of directors who are independent. By keeping the Media Super brand, each of our members can be confident that they will have a voice within a much larger fund, and that our focus and support for those employed in our unique industry sectors will be maintained. I have felt privileged to have the opportunity to guide Media Super through this important process, and all of us at the fund are excited to keep you informed of our milestones and progress along the way. At this juncture, I'd like to hand back to Shauna Black, who will now have the pleasure of introducing our Chief Executive Officer, Tony Griffin. Thank you.
Thank you, Susan. Next up is Media Super's Chief Executive Officer, Tony Griffin.
Thank you, Shauna, and thank you, Susan. And thank you to everyone for joining our 2021 annual members meeting. And as Shauna has mentioned, while we are obviously now in the 2022 calendar year, I feel I do need to clarify that this meeting is reflective of the financial year 30 June 2021. I'd also like to acknowledge the traditional landowners that I am presenting from this evening, and that is the land of the Eora Nation. I'd like to welcome our members, employers, partners, staff, and the board who will join us this evening, along with my fellow speakers and Media Super colleagues, Chair Susan Heaney and Chief Investment Officer Michael McQueen. Thank you all for working with us as we bring this event to you virtually this evening. When I spoke with you at our last annual members meeting back in November 2020, I acknowledged that we had just been through a challenging year and that we were going to see the impacts of the COVID-19 pandemic evolve here in Australia and around the world. Well, here we are now 15 months later, and I'm sure you probably don't need me to remind you of this, given how profoundly impacted our core industries have been. Unfortunately, we still find ourselves dealing with significant repercussions from COVID, despite the ongoing challenges. There is now at least evidence that the Omicron wave is likely to have peaked in much of the country. The past year has continued to present us with a lot of uncertainty. There is one thing you, our members, employers, and partners can be certain of, and that is that everyone at Media Super is working extremely hard to ensure our members have the relevant resources they need on their journey towards a comfortable retirement. This is what drives everything we do. No matter what may arise, this commitment does not change. And I'm proud to lead such a passionate executive team as the one we are lucky to have here tonight at Media Super. We know our members have once again continued to do it tough this past financial year. That's you, our members. Our core industries of print, media, entertainment, and the arts remain severely affected by the pandemic. And we at Media Super continue to be here to help you. We've supported our members through lots of change over the past 30 years. We understand the challenges you and your industry are still facing, and we're working hard to support you through this situation wherever we possibly can. Since April 2020, around 3.5 million Australians have made the difficult decision to access their super early to help ease the financial burden that's been created by this pandemic. The second round of payments between the 1st of July and 31st of December 2020 saw 8,832 Media Super members access their super early. More than 5,000 of these were second payments, and the average withdrawal was approximately 8,800 per member. The early release payments due to COVID-19 are now longer available. The government's withdrawn that scheme. But if you are still struggling, you may be able to apply for a severe financial hardship payment or a payment on compassionate grounds. There are conditions to these particular types of claims, but you'll find more information about this on the MySuper website. If you've accessed your super in 2020 under the COVID-19 early release scheme, you'll be able to recontribute the amount to your super account without it counting towards your annual after-tax contribution cap. These recontributions can be made between the 1st of July 2021 and the 30th of June 2030. So there's a bit of time left there to be able to recover those contributions and top back your super up. The most significant change for working members is that your super account is now stapled to you, and it will follow you from job to job. So there's been quite a bit of change in the last 12 months in regards to regulatory change. So this is one of the key changes that's come in recently. So this stapling replaces the previous system where many people joined a new employer's default fund and ended up over time with multiple super accounts. This change took effect from the 1st of November 2021. In addition, the Australian Prudential Regulation Authority, that's the key regulator of the financial services industry, is now conducting annual performance tests of all MySuper products. Results will be released on the 31st of August each year. I'm extremely proud to confirm that MySuper officially passed the most recent performance test. There were a series of funds that didn't. Other changes that have been introduced include the ATO Your Super comparison tool, which is now available, obviously, on the ATO website to help people compare multiple funds, particularly around MySuper products, and on a more efficient basis. And then you can choose a fund that best meets your needs from that comparison tool. Furthermore, the cutoff age for accessing the bring forward after tax contributions cap has increased from age 65 to 67. So people aged 65 and 66 on or after the 1st of July 2020 are now able to make up to 3 years of after-tax non-concessional contributions. And you can do that without breaching your annual contribution cap. Another one of these initiatives is in March 2020, the federal government halved the minimum pension drawdown amounts temporarily due to the financial impacts of the pandemic. And that was to allow retirees to keep more of their retirement savings invested, In May 2021, the federal government announced the temporary minimum pension drawdown amounts will be extended to the end of June 2022. In relation to investment returns, shortly you'll hear from our Chief Investment Officer, Michael McQueen, who will talk you through our investment performance in more detail. But I'm delighted to report that despite the challenging economic times, financial markets rebounded very strongly after significant falls in early 2020. Our balanced MySuper option returned 16.82% for the financial year, and the pension balanced option returned 18.8%. Not only do these strong double-digit returns result in increases in members' account balances, but they also are the highest annual returns MySuper members have experienced in more than 20 years. The size of the fund also grew by $1 billion in a little over 12 months. Quite extraordinary. Of course, it's important to remember that superannuation is a long-term investment. Over the medium and long term, MySuper's balanced options have exceeded their investment objectives and performed above many of our peers. The balanced options return over 3, 5, 7, and 10 years are all above the median, with the 5-year returns in the first quartile. Meanwhile, the pension balance options returns for 3, 5, 7, and 10 years are also above the median, with the return for the 5 and 7 years in the first quartile. As I mentioned earlier, attending to the best interests of our members drives everything we do. Looking ahead, we're confident our investment strategy is well positioned to continue to helping members achieve a comfortable retirement. As I've mentioned, after some sustained investment losses due to the impact of COVID in 2020, the 2021 year saw financial markets rebound strongly. MediaSuper's assets under management grew to over $6.9 billion, up more than 16% on the year before. However, there were also some significant cash outflows relating to the COVID-19 early release of superannuation scheme, which I was talking about a bit earlier. And that was the federal government's temporary measure to stimulate the economy. For the year ended 30 June 2021, MediaSuper members withdrew $75.7 million in benefits under that scheme. Nonetheless, revenue from fund's total superannuation activities was up more than $1 billion on the previous year. As part of Australia's creative community, MediaSuper also works with our industry partners to help them build vibrant and robust sectors. This includes initiatives such as the Australian Film, Television and Radio Schools Screen Business Essentials program. It's a mouthful, that one. The Screen produces Australia's One to Watch program and also its Screen Forever conference. We have also continued to provide opportunities for emerging talent to gain sought after on-the-job experience through internships and to gain invaluable insights through mentorships. We've continued to support awards across our core industries, including the Equity Ensemble Awards, the Australian Graphic Design Association Awards, the Printing Industry Craftsmanship Awards, the National Print Awards, the Walkley Awards for Excellence in Journalism, the Pro Print Emerging 50, and the Australian Book Industry Awards. These are just some of the ways which we give back to our core industries and support our future leaders. Susan talked about this in her discussion a bit with you as well, but you might recall at our last annual members meeting that I confirmed we were considering potential joint arrangement opportunities. And at the time, we were investigating the possibility of a merger with a larger fund that would allow us to access the benefits in size and scale for our members. Whilst we fast forward a few months later to July 2021, and MediaSuper did indeed sign the merger agreement that Susan was referring to. And CBUS was that organisation that we're partnering, and CBUS are the industry super fund for those who build Australia. Yes, CBUS share the same values and mission as MediaSuper, which are to provide the tools to build better retirement outcomes for our members. The MediaSuper brand and industry focus will be maintained, and MediaSuper members will transfer into the CBUS Super Fund with United Super Proprietary Limited as the trustee. This will allow members to benefit from products and services tailored to our member industries whilst accessing benefits of size and scale. Now, a significant event notice went out this week. It's starting to now drift out to you. Some of you may have already received the significant event notice. And this is a document, quite a lengthy document, it's about 20 pages long, in which division of the fund you're in, which gives you a lot of information about the actual successor fund transfer. It's targeted for April 2022. The merged fund will have assets of approximately $72 billion and manage the retirement savings of 847,000 members. So our joint focus is squarely on delivering strong long-term investment returns for all MediaSuper and CBUS members and providing the products that is required now that our system is starting to mature and lots of people are now starting to move into retirement phase. You may be well aware that there's currently significant merger activity occurring within the entire superannuation industry, as more and more funds seek to access the benefits of scale, which include investment diversity and greater product potential. I'd like to remind you and assure you that MediaSuper acts in our members' best interests, and any decisions we make will always reflect that ethos. I'd also like to take this opportunity to thank my executive team. It's been a unique year, and for so many reasons, I am proud to lead this talented group of professionals. So to finish off, and in the spirit of this comparatively new year, I wish you all a safe and healthy 2022. Thank you once again for your membership, your support, and your attendance this evening. I'll now hand back to you, Shauna. Thank you very much, Shauna.
Thanks, Tony. And it was great to see those investment returns for those of us who are long-term members. We haven't seen a return like that, so it's very heartening. Thanks, Tony. A reminder to everyone online tonight to continue to ask your questions using the Q&A function at the bottom of your screen, and we'll get to those after we hear from our next speaker. I'd like to introduce you now to our Chief Investment Officer, Michael McQueen. He'll now take you through MediaSuper's results and returns for the past financial year. Thank you, Michael.
Thank you, Shauna, and welcome everyone. As our annual members meeting is also being held on the lands of the Wurundjeri Woi-wurrung people, I'd like to acknowledge them as the traditional owners and original custodians of this land. We pay our respects to their elders, past, present and emerging, as well as the elders of other Aboriginal and Torres Strait Islander communities who may be here with us today. The 12 months to 30 June 2021 was a period of strength for the price of both real and financial assets. Growth assets, which are stocks, essentially shares, and mid-risk assets like property, infrastructure and credit continued to rally largely unabated throughout that financial year. This was thanks to the continued provision of liquidity into financial markets and the banking system by the major central banks. Now, this liquidity was pumped into the system by a number of monetary policy levers, including quantitative easing, expanding central bank balance sheets and near zero interest rates. Now, as you've heard previously from Tony, our balanced MySuper option and our balanced allocated pension options have performed well over the long term. It's worth noting that over the 5 years to 30 June 2021, the balanced MySuper option, which most of our members are invested in, delivered a return that was within the first quartile of all other super funds. For members invested in other options, we delivered solid relative returns, and a few of those I'd like to take a minute to note now. The high growth option was above median over 3, 7 and 10 years, and was in the first quartile over 5 years, like balanced was. Stable 2 was above median over 3, 7 and 10 years, including being in the first quartile over 5 years once again. The cash option, which isn't a premixed diversified option like the other ones I've mentioned, but does attract a decent share of fund and account balances. That cash option was above median over 5, 7 and 10 years and included being in the first quartile of other cash options over the last 3 years. As I said in last year's annual members meeting, looking at the return per unit of risk is a really great way to see how efficiently your investment options are performing. Now, looking at these returns per unit of risk, I can make the following observations against our peer group. The balanced MySuper option was above median over all timeframes, being 3, 5, 7 and 10 years, and achieved top quartile risk-adjusted returns over 3, 5 and 7 years. High growth was above median over all periods and was a top 10 fund on a risk efficiency matrix over 5, 7 and 10 years. Growth 2 was above median over all time frames, including being a top quartile fund over 5, 7 and 10 years. And we did see stable as a top quartile fund over all time periods. The reason why I talk about this sort of somewhat obscure metric is I'm really trying to reassure you, our members, that these strong returns that we've generated across our MediaSuper options, they haven't been generated with risky or speculative positions being made in your retirement savings. Those risk-adjusted returns are quite strong. Turning to the performance of our pension options, our balanced allocated pension option was above median over the 12 months to 30 June and was actually in the top quartile of its peers over the last 3, 5, 7 and 10 years. It was also a top 10 performing fund within its cohort over the last 5 and 7 years. Looking at some of our other pension options just quickly, the growth allocated pension option was a top 10 fund over the last 3 and 5 years. Stable allocated pension delivered above median over 7 and 10 years, and was also a top 5 performer over the last 3 years and a top 10 performer over 5 and 7 years. Now, having discussed our returns for the financial year, being the previous financial year to the one we're currently in, I'd also like to talk about some of the changes we made across the fund. Now, if we take our minds back, because a lot has happened, as the 2020-2021 financial year began, many countries around the world were locked down, either in full or in part. Vaccines were only just being developed, hadn't entered trial phase yet, and there was a distinct possibility of a wave of corporate defaults and defaults in small businesses too. It was quite a concerning period of time. With this backdrop of uncertainty and against a remarkable rebound in financial markets that we saw in the fourth quarter of the previous financial year, at the start of 2020-2021, the fund maintained a slight underweight position to growth assets across our premixed options when compared to our strategic asset allocation targets. Moving the timeline forward, once vaccines had been developed and trial results were positive, it became quite apparent quite quickly that the rebound that we'd seen was not at risk as it was in the early months of that financial year, like July and August. So things did change quite markedly. Therefore, in the second quarter, we increased our allocation by our dynamic overlays for our premixed options, which includes the balanced option. This improved investment returns into the second half of the financial year. And against a backdrop of strong corporate earnings and strong consumer confidence too, we increased exposure to equities further in the fourth quarter of the financial year. Now, after a very, very profitable period for the balanced options portfolio protection overlay in the last financial year, being 2019-2020, in the previous financial year, 2020-2021, we had a moratorium on new positions in that overlay. What that means is that it allowed gains that the fund experienced in the increased prices of shares in stock markets globally to fall fully to the bottom line and to not be somewhat hedged away. Now, we also slightly reduced the fund's exposure to foreign currencies in order to retain a higher exposure to the Australian dollar, as it did trade at a small discount to its trade-weighted index and to commodity prices as commodity prices themselves rose. We rebalanced between our Australian equity managers, essentially to position that sector for success against this new backdrop which emerged, which was a backdrop of a strong bull market. We did that by increasing our exposure to small cap stocks and growth companies as well. Within the alternate debt sector, we worked with our largest manager in that sector to unwind our largest investment into 3 separate underlying strategies and recalibrated exposures across those strategies to improve returns, again, against the backdrop of a very strong environment and with those corporate defaults not coming through as we somewhat expected to see. We also increased our commitment to private equity in the last financial year, being 2019-2020. And then in 2020-2021, we worked closely with our key manager there to deploy capital and identify compelling opportunities in emerging markets and also other attractive opportunities in the buyout and distressed debt sectors. It would be remiss of me not to address environmental, social, and governance activities, which is a key passion of mine. So I'd like to touch on those in this briefing. We continued, as we always do, to raise our concerns around climate change with companies that we own, and we were active in voting at annual general meetings. Now, whilst we didn't support all of the climate change resolutions put forward by the activist groups and the lobby groups, mainly due to technical deficiencies in those resolutions, which, in all honesty, were most likely drafted to generate headlines and stir the public debate, we strongly believe that those activists and those lobby groups have a key role to play in Australia's pathway to net zero. Touching on social issues, which is the S within ESG, one of the big issues we're involved in the last financial year was the potential for a large liquor store to be opened within the 5K exclusion zone of 3 separate Aboriginal communities in Darwin. Now, we were able to raise our concerns directly with the landlord and participated in the subsequent external review that the liquor chain's listed parent company commissioned to review that decision that was made. So after this external review recommended against the opening of that store, the listed company ended up agreeing with it and cancelling its plans. The reason why I've conveyed this and told you this is a fantastic example of the power of advocacy, which can occur outside the public eye. The dialogue that we had and other funds had was only possible due to our direct ownership in both cases and our commitment, public commitment, which we make to our members, to be active owners and responsible stewards of your capital. If the fund had taken the path like some other funds have to divest from the listed parent company in this example, we would not have been able to raise our concerns directly with that executive team, and we wouldn't have been able to convey to them our concerns with the potential negative impact to their brand value, their social license to operate, and their equity risk premium. So just finally on ESG, looking at corporate governance, we also saw an increase in what we deem to be excessive remuneration packages for company executives. Often they were there to make up for incentives that were lost or forfeited during the pandemic. As hopefully you'd expect, we made our concerns known with voting against those remuneration reports where appropriate. Turning to the outlook for this financial year that we're currently in, despite what we've seen in the last 48 to 72 hours, we do see a positive macroeconomic picture. Whilst inflation will remain at the forefront of investors' minds this year, it's not expected to cause a significant repricing event in growth assets like shares, or downgrades to the corporate earnings which underpin the value of those assets. Whilst monetary policy is being wound back and the price of money itself is going to increase, there is strong aggregate demand in most major economies, which we believe will absorb this change. Industrial production, a favourite metric of mine, is still growing, and other similar indicators are still expansionary as opposed to being contractionary. This can be seen in the real world with the high prices of commodities, especially coal, which is used in the manufacturing process, the direct result of supply and demand, essentially. Corporate earnings, as I've spoken about, remain strong. And whilst inflation is currently high, there's no sign at present that that high inflation is eating into companies' margins. However, having said that, inflation will likely settle at a higher watermark in the years ahead compared to the last decade where we've seen very, very low inflationary figures. Demand for real assets, such as property and infrastructure, is increasing, and we're seeing many, many more transactions this year. Similarly, as you may have seen in the press, there's a mergers and acquisitions boom going on in many stock markets, especially in the Australian stock market, which is being funded by low credit spreads and a willingness of banks and debt investors to continue to lend to these buyout consortiums. So, in summary, despite the volatility that we're currently seeing, with investors and speculators taking a risk-off stance in the last 48 to 72 hours, based off the underlying fundamental data, the medium and long-term outlook for your retirement savings is still positive. Thank you for your time, and back to you, Shauna.
Thanks, Michael. I think we're always interested in environmental, social and governance, ESG stuff. And I think it's been a very big year for that. So I always enjoy our conversations about whether we should divest from a particular investment or whether we should stay at the table to stay engaged with that company. So I hope those conversations will continue. That concludes the formal part of our evening. We'll now move on to the question and answer section. Just to let you know, we've had a lot of questions come through. So thank you to everyone who submitted their questions when they registered. Thanks also to those of you who've asked questions online now, and we're just looking at those. I will quickly answer Sue though. Sue, you asked us how many people were on this meeting tonight. Sometimes it can feel a bit odd because we're just looking at our screens, but we had more than 200 people registered for tonight's meeting. I would like to think they're all online, but perhaps international events have taken some of them away from us tonight. But nevertheless, all the important people are here, of course. Just a reminder that any questions that relate to your account or specifically to your circumstance cannot be answered in this format. And if we don't get to your question because of time constraints or legal reasons, we'll have a response to your questions available on the website in the next few weeks. So let's get started. The first question that we can answer tonight comes from Nonabel. And Nonabel has asked, does the merger with CBUS require members to do anything? And I'd like to pass this question over to our chair, Susan Heaney to answer. Oh, no, sorry. So I think I'm passing that one to Tony. Tony Griffin, our Chief Executive Officer. Thanks, Tony.
Yes, you are, Shauna. Thank you. Can everyone hear me? Yes. Well, yes, actually, Bill. That's a great question. And there are definitely actions for you as members that you can take. And the first thing to do is to read that key document I was talking about in my speech, which was the significant event notice. It's a key document. We've poured over that and done a lot of work on that. Many sets of eyes, let me assure you, we've gone over that document. So that's been sent to you. If you haven't got it yet, it will be coming to you in whatever means you've selected, whether that be electronic means or whether it be printed means. So, so that contains some very important information about changes to your account and any specific action you might need to take. Everyone's got different circumstances, so that's why you've got to read that document carefully. Also, as members, you need to be aware of our limited service period. So when you're doing a big lift and drop data conversion type activity like this, there is, it takes, we have to do the job essentially in proportions. So there's certain transaction and services that will be unavailable. If a member requires a particular transactional service from late March to end of April, you will need to request it before the cut-off dates. And these cut-off dates are clearly listed in the significant event notice. This applies to all members across super and pension products, and we expect the full services to resume around the 26th of April. After that, once CBUS takes over as trustee, members will also receive an information pack in May with their new member numbers, and also with details of the new member portal and other important information which is relevant to you. For any help or information, you can refer to the significant event notice, or you can also contact the helpline. And our contact number for the helpline is 1800 640 886, or you can visit our website, which is mediasuper.com.au/merger. Thanks, Shauna.
Thanks, Tony. That's quite clear. So thank you for that. I'll just repeat that helpline number for those of you who are quickly grabbing a piece of paper and a pen. That helpline number is 1800 640 886. Also, just while Tony was speaking there, the staff have let me know that we actually had more than 300 registrations for this meeting. So that's, I think that's more than double than what we had last year. So there's certainly a lot of interest from our members out there. Just going through the questions now, my next question is from Deirdre. And Deirdre asks, how ethical are MySuper's investments? And Michael, just having spoken about our ESG responsibilities, I'm wondering if you can handle this one for us, please.
Thank you, Shauna. Hi, Deirdre. Thank you for what's really an important question. So I've talked previously about the power of advocacy and stewardship already in my investment update with regards to that liquor chain. And I think that's a fantastic example of us acting ethically. Now, generally, we don't look at how ethical our investments are per se. Instead, we prioritise the act of being ethical and acting as a responsible investor and a responsible steward of your retirement savings. Divesting from or not investing in companies that could be considered unethical means that we don't get a seat at that table and we're unable to positively influence that company's corporate strategy, improve the value of their brand, restore their social license to operate. So in certain circumstances where we've been at that table and we haven't been able to influence companies to improve their corporate practices, such as in tobacco and coal, we have divested. But generally, that's not the approach we take. We're not a exclusion-orientated ethical investor or responsible investor. Now, this option is always open to us. We are optimists, and we do prefer to have those genuinely hard conversations with management and directors rather than just sell out and move on. So that's the way we act in an ethical manner on your behalf.
Thanks, Michael. It's certainly a topic that we could discuss at some length, and I hope people will have those conversations as we go forward. Our next question is from Ian, and Ian asks, will the changes from this recent merger negatively affect the great growth that we've seen from media super funds prior to it? I'm presuming he means that will we see the great returns going forward with the merger? And I think I might ask Susan if you could answer this one, please.
Thanks, Shauna, and thanks, Ian. I'm sure that's a question on a lot of members' minds at the moment, but contrary to having a negative effect on our growth, the combined size of Media Super and CBUS will be $70 billion in funds under management. Along with that, as of June 30, 2021, there was 850,000 members that we were responsible for managing the retirement savings of. So that those two facts together will make it one of Australia's largest superannuation funds. So Media Super will become part of a much larger and a growing fund. We actually believe that the merger will deliver more benefits and security for our members in the years ahead, much more than we could sustainably deliver as a mid-sized standalone fund. The benefits of accessing greater size and scale can include, but aren't limited to, access to greater range of investment opportunities, making it easier to diversify and maintain members' strong net returns. There's also greater opportunities to reduce fees, both administration and investment fees. And it also gives you innovation in retirement products, all things that will go towards growing our members' retirement savings funds. So hopefully that goes away to answering and allaying some of your fears. Thank you.
Thanks, Susan. Returning to our questions now, I think I will return to a question asked by Nonabel. Does the merger impact the existing member accounts or logins? And I think I'll go to Tony for that kind of technical question, please, Tony.
Yes, there is quite some changes that are happening with the accounts. We're moving off one platform to another. So what that actually means is when the system moves over to CBUS, there will be a change in membership numbers as well. And then that information, as I mentioned before, will come out in the May-related communication that will be issued by CBUS, and there'll be information in there about the portal and the logins in order to assist members as well when they're going into the system for the first time. Remember, all the services are coming up on April 26th, so the May release by CBUS is timed within that particular time frame. Thanks, Shauna.
Thanks, Tony. We've got time. If you want to send a question through, please do it now using the Q&A button because we are nearing the end of our presentation. I have a question from Stephen. How are you dealing with ESG issues? What do you think of Frydenberg's attack on proxy advisors? Do we disclose how we vote? It's a very topical issue in investment. We have covered a bit of this, but perhaps, Michael, you could tell us a bit more about the proxy advice situation.
Thank you for your question, Stephen. Crikey, it's a good one. So I've given some insight previously in this forum and in last year's annual member meeting around how we deal with ESG issues. So hopefully that answers the first part of your question. In terms of the second question, as I've said previously, we are an active owner and we do participate in corporate engagement opportunities that quite often are organised by our proxy advisors, engaging with those companies directly as required. This structure through our proxy advisors creates substantial economies of scale, and by centralising those corporate engagement and reporting activities, it helps us keep our fees lower for members. If the proxy regulation survived for 3 years rather than 3 days, there's no doubt in my mind it would have pushed up the cost of managing your retirement savings. It does appear at a headline level, I don't have any insight, but it does appear that this regulation was designed to shift the balance of power towards listed companies at the expense of both small and large shareholders. And recall that a super fund essentially is a collection of small shareholders. It would have also created a terrible precedent of regulating the distribution of proxy advisors' intellectual property for free to companies, which would no doubt have devalued their product, i.e. their reports, their services. Over time, that would have reduced their economies of scale, which would have an impact on us. It's curious to me that we didn't see these regulations raised or let alone enacted by delegated authority within the stockbroking or the investment banking space with regards to their research reports that, in all honesty, can really move around the price of a share that that report is based on, which begs the obvious question, why did we need it here? Touching on your last question, we absolutely do disclose our voting records on our websites, singular. And look, going forward with CBUS, there'll be more reporting and greater transparency on our holdings and how we vote. So hopefully that's a nice thing to look forward to for you, Stephen.
Great. Thanks, Michael. As I say, it's a very topical issue, and I think that we could probably sit here and discuss it all night, and some of us might do that later. We have another question here from Rory, and Rory is asking, what is happening with the CBUS takeover? Will all my dollars be protected, my fund dollars be protected? And I think that I will hand that question to Tony.
Thanks, Shauna. And good question, Rory. Yes, absolutely. It's important to remember, Rory, that this is a merger, not a takeover. So MySuper made a very active choice in the best interests of you, our members, to find the right partner to help us maintain our objective of providing strong outcomes for our members in retirement, and also to manage environmental factors like rising costs and the increasing complexity of superannuation. It was a very considered decision, and we found CBUS to be the right partner. And this is a thing for all of us. Confronting a challenge in a different environment can be very uncomfortable, but it's the only way we're going to be able to move this fund to the next step, to be competitive with the much larger funds, the big mega funds out there, that including CBUS, it's growing in that direction, that are competing in this environment and more complex environment during these times. So the merger brings together the two funds' investment, administration and operations, and both the MySuper and CBUS brands are respectively retained. MySuper brand and industry focus will continue, as we've talked about before, and it'll be part of a much larger and growing combined fund. CBUS has a history of low fees, very strong investment performance and excellent service. And it's run by an extremely competent leadership with Wayne Swan as the chair, Justin Arder as the CEO. He's had a very, very distinguished career in financial services, and all his team are very competent people. So we'll benefit from increased scale and growth, and we'll be able to provide access to more investment opportunities, greater scope to manage fees effectively, and access to products and services, including for those approaching or currently in retirement. And we've got the retirement covenant, which is coming in from the government on the 1st of July. And that's a covenant for the entire industry to build a much more robust framework to guide members through the entire journey, from when you start your job through to when your career finishes and you go into twilight of your career and then into your retirement itself. So in relation to members' funds being protected, Rory, we have the highest confidence in CBUS managing our members' funds. That was the key criteria in choosing to partner with CBUS. And they are very highly regarded, as I was saying before, and they won a numerous number of awards for excellence in what they do. So they are superior funds. Back to you. Thanks, Shauna.
Thanks, Tony. And we are almost out of time tonight. I'd just like to note that we had more than 50 questions submitted, as well as more online live. So 50 pre-questions. A lot of them are kind of nuts and bolts questions about your own personal superannuation fund. So I invite you to either go to the MediaSuper website or to call the helpline that we mentioned earlier in the meeting, because you can find specific answers there. For example, Jeff has asked us tonight, how much super does the average Australian need to retire at age of 67? There's a great calculator on the MediaSuper website, and I invite you to go there. I've used it myself, and that will help you to plan out your retirement. And you can always get more help by calling the helpline on 1800 640 886. So just a reminder that any of your questions that were not answered will be answered online at a later date if you don't get an answer directly from MediaSuper. And also this meeting is recorded tonight. Minutes of the event along with your responses will be online, and in another year, once again, everything that's been thrown at us, we hope you found some comfort in the results and dedication of the team at MediaSuper. So I'd like to thank everyone for tonight's meeting. Thanks for coming to the meeting. Thanks for talking, Michael, Susan and Tony, and a team of people in the background who are making all of this happen. And please stay safe and well.